Hello, Chess and Wine here on Monday, January 31st, 2011. I want to do a video market recap for you. Here is a 30-minute chart of the S&P 500, and you can see off to the right-hand side of your screen, we closed just below 1286 today in the S&P, 1285.95, and I've drawn this line, this horizontal pink line here, dating back to January 12th of this year, so several weeks back. And you can see that we were just kind of dancing along 1285 as well back then. Ever since then, over the past few weeks, we've gone briefly above, and we appeared to have broken out, but then we went briefly below it, and kind of we've gone back and forth. But either way, price seems to be wanting to revert back to this 1285 line. Therefore, bulls who've gotten long in anticipation of the big breakout well above 1300, they've been equally disappointed and chopped up as bears who've been positioned and heavily short for the big breakdown. So hence, we continue to be in this kind of neutral, choppy, broad market setting. To be sure, we have seen some individual plays that are working, but I would argue that the number of them and the pockets of momentum and real high quality long setups that actually are sustaining bona fide breakouts, that pocket is shrinking, and I think the number of kind of quality long setups seems to be dwindling as we speak. But then again, at the same time, that doesn't mean it's necessarily correct to position yourself aggressively short. For example, if you had gotten short into Friday's kind of little bloodbath there, you would have been disappointed today. There was no downside confirmation. So hence, again, the broad kind of neutral, choppy range here in the broad market, even though, as I'll show you in a moment, there are definitely some warning signs beneath the surface and some daily charts of the leading indices and sectors. So here's the daily chart of the S&P 500, and to that point, you can see we had this well-defined rising price channel dating back to early December, and we finally sliced through it as well as a 20-day moving average on Friday with this big red Mariposa with a little bit of a wick on top of the candle from the first 30 minutes of trading. And today, really, all we did was just kind of retrace back to that prior support trend line, and that's really one of kind of the basic tenets of technical analysis is you're looking for situations where prior support turns into current resistance, and that kind of can aid you in determining change in trends and inflection points and that kind of thing. So we're really looking to see whether whether price can climb back into this rising channel, or alternatively whether the bears are actually going to go ahead and win this battle and price is going to be turned away. And if that's the case, we've got quite a ways to drop down here before we even get down, let's say, for example, to the 50-day moving average, which is just below 1250. So that's something definitely to keep on watch. A similar kind of situation with the NASDAQ composite, big red Mariposa on Friday, and today, really, even though at times it seemed a little, like the bulls were kind of breathing a big sigh of relief because the Egypt situation didn't kind of metastasize into further downside in the market today. You can see the bulls were unable to get back, even to puncture the midpoint of Friday's candle, and clearly were unable even to do a full retrace up to this prior support trend line, again with this rising channel dating back to early December. So it's tough to really say that the bulls made a whole heck of a lot of progress today, and that leads me to one of the big warning signs in this market. One of my main leading indicators in the market for the past years, for the past few years, I should say, really since I've been trading, this has been a key indicator. The Dow Jones Transportation Average, the trannies, you can see on Friday slicing through a well-defined area of support dating back to early December, not to mention the 50-day moving average. So again, the trannies are, the daily chart is much weaker than the S&P 500. As I told you, the S&P 500 has quite a ways to go before it gets to its 50-day moving average, whereas the trannies are already, again, for the second session in a row, closing below the 50-day moving average, not to mention below this key area of support. Again, another issue to watch. Is this prior support now going to turn into current resistance? If so, we could see a rather quick drop further. So that's just, again, something to watch for. The trannies are, in my estimation, a big warning sign, as are the emerging markets. Similar kind of situation, very weak below the 50-day moving average. You can see this inside day candle here by the bulls, not particularly impressive. Likewise, finally, the Russell 2000, this broad megaphone formation, another warning sign.